At its peak, Enron wasn't just rich. It was admired, studied, quoted. In the year 2000, Enron was more than $70 billion, sixth largest company in America, praised as the smartest company in the room. 1 year later, it was gone. Not shrunk, not wounded, erased. And that's what makes Enron dangerous? Because this wasn't stupidity. This was intelligence used the wrong way. If you want to avoid the next Enron disaster, there are 5 simple lessons hiding in plain sight, and none of them are about energy. Enron began as something boring: natural gas pipelines, predictable cash, reliable margins. Wall Street doesn't reward boring. So when energy markets were deregulated in the 1990s, Enron reinvented itself. Not by drilling better, but by trading promises about the future. Electricity wasn't power anymore. It was a contract, a number, a financial product. Here's lesson 1. If a company makes money in ways that are hard to explain, be careful. Enron's profits didn't come from customers. They came from math. Under a system called mark-to-market accounting, Enron could book years of expected profits the moment a deal was signed. Not when cash arrived, not when electricity was delivered. On day 1, if a contract might earn $100 million over 10 years, Enron recorded it immediately. Future hope became present income. On paper, Enron looked unstoppable. In reality, much of that money didn't exist yet. Which leads to lesson 2. Revenue is not cash. Cash pays salaries, cash pays debt. Cash keeps companies alive. Accounting profits don't. As long as deals kept coming, the illusion held. But when deals failed, Enron faced a problem: losses. So they hid them. This brings us to lesson 3. If losses disappear instead of being explained, run. Enron created special partnerships that lived off the balance sheet. Officially separate, privately controlled, bad deals were quietly pushed into these entities. Debt vanished. Earnings stayed clean. The most disturbing part: Enron's own CFO helped design the system and personally made tens of millions from it. Risk wasn't removed, it was relocated. Banks approved the structures, auditors signed off, rating agencies hesitated. Everyone saw fragments, no one wanted the full picture. Which leads to lesson 4. When everyone benefits from silence, truth becomes expensive. Inside Enron, questioning numbers was career suicide. Employees were ranked aggressively. Critics were pushed out. Optimists were promoted. Outside Enron, analysts admitted they didn't understand the business. They still recommended the stock. Because saying, "I don't get it," felt worse than being wrong together. Then reality arrived. In 2001, journalists asked basic questions. Credit agencies grew nervous. Confidence cracked. Once trust broke, it broke fast. The stock fell from $90 to pennies. Hidden debt surfaced all at once. Enron filed for bankruptcy. Thousands lost jobs. Retirement savings evaporated. A corporate icon collapsed in weeks. Which brings us to the final lesson. If a company is praised as too smart to question, that's the question. Enron didn't collapse because people lacked intelligence. It collapsed because intelligence replaced skepticism. Complexity replaced clarity. Reputation replaced verification. Confidence replaced cash. The smartest people in the room weren't lying about being smart. They were wrong about what mattered. So when you hear the next revolutionary company praised for rewriting the rules, when profits depend on assumptions about the future, when numbers look amazing but cash feels distant, ask the simplest question in finance: where is the real money coming from? Because history has already shown us what happens when no one asks it.